Hi, everybody. I am Jane Migdol with Gibson Sotheby's with the MigdolMoore team. I'm my teammate, Nancy Moore. And also our guest today is Greg Giokas. Greg is a senior loan officer with Guild Mortgage. And Greg has graciously volunteered to answer some questions for us, questions that our buyers are coming up with day in and day out. And we figured we'd ask the expert. So Greg, thank you for being with us.
Well, thank you as always for the invite. I always enjoy our time together, so thank you very much. As I mentioned, all of you are very lucky to know Nancy and Jane. They do great work for their clients, and they're just really good people in general, which I think is very important. So I appreciate the invite.
Thanks, Greg.
Greg, nice to have you here.
So I think the first question is, why are the rates increasing so dramatically now? What has happened that has changed everybody's life?
Yes, that's a great question, a very loaded question. So I think we have to go back to the beginning and look at how much have rates increased since January effectively, right? Is when we started to see this major movement in rates. So I think at the beginning of the year, we started off on average, rates were probably around 3%.
Right.
Now, again, on average, it can vary from program to program, but on average, rates are probably around 6% at this point. So that's a 3% increase in less than 6 months.
Right.
That is very significant. I think I don't know the exact time frame, but I don't think that we've seen this type of increase in rates since probably the 80s. Okay. So really what it comes down to is one word: inflation. And inflation has been a word that's been batted around for the last 2 years, but there was another word that went in front of it, which was transitory. And for a very long time, a lot of experts believed that inflation was transitory, meaning it would come and pass. And they thought a lot of it was due to the pandemic and the fact that people were home and the fact that the government was supporting people, which was the right thing to do at the time with stimulus checks. So people were building up their savings. They weren't going out and spending any money, so they were saving a lot. I think at the time they said the peak savings rate was 34%.
Yeah.
And to put that in perspective, right now, the savings rate is 4%. So people were saving like crazy, right? And they were spending money in very specific areas like goods, right? And then on top of that, to compound that is, because of the pandemic, people were taking time to buy things because they were at home. But also there was a backlog of manufacturing because a lot of people were out of work, whether there were COVID restrictions or people actually had COVID and all that stuff. So it all kind of came together. And for the longest time, all the experts, including the Federal Reserve, believed that it would come and pass. Well, unfortunately, that didn't happen. So they missed the mark on that. So now, fast forward to January, and they saw these numbers continuing to increase. And then the Fed basically said, now's the time for us to make a conscientious effort to slow down demand, okay? Unfortunately, they can slow down demand, but they cannot control the issue with supply. That is still kind of a lingering issue that will stay with us for some time, right? Who knows how long, maybe a year, maybe 2 years. So there is a little bit of a concern in that the Fed can control demand, right? They can cool down demand, but at the same time, the Fed can't control what's happening on the supply chain, all the supply chain issues. They're hoping that with the slowdown in demand and maybe the supply, these manufacturing companies can catch up and build up their supply to meet demand. But for now, that's not the case. So when inflation now becomes a real concern this year, mortgages are traded in a secondary market like a stock market. So there's buyers and sellers, right? There's investors that buy these mortgages. And when inflation is an issue, buying a long-term investment like like a mortgage is not a good investment. Because if you think about it, if you owe me money and I give you a loan and I'm collecting $1 from you every month and the inflation rate is 8 or 9%, I'm losing 8 or 9% on that dollar every single month. And these are 30-year mortgages or 10-year mortgages, whatever. So it's not like a 1 or 2 month investment. These are long-term investments. So investors were not incentivized or actually fearful of buying these mortgages. And when there's no demand to buy these mortgages and there's still mortgages being written, that drives down the price of these mortgages. And when prices come down, the inverse happens with rates. It increases the interest rate. So that is what's been going on for the last 6 months. Okay. So investors are very much in tune with how inflation is moving. They're not so much concerned with where the inflation rate is right now because we know what it is. It's 8%. They're more concerned about where it's trending. Is it trending up? Is it trending down? Okay. If we pay close attention to the inflation rate, the CPI index or the PCE that we talk about, we want to see a gradual decline because that will tell us that the inflation has peaked, and these investors will look at this and say, okay, rates are higher, I'm getting more money on my investment, inflation is no longer a concern because it looked like it's peaked, and that will help stabilize these interest rates. That's not happening right now. In fact, last month we had an uptick, which caused another uptick in interest rates, an uptick in inflation, in other words. For a few months, we started to see a decline. Then last month, we saw an uptick, and that just basically threw a monkey wrench into where rates were trending. And then we saw another uptick in rates. So hopefully, as we move forward into the summer, the fall, into the winter, again, pay attention very closely to where inflation is trending.
Got it.
So my question for you, Greg, is what are you seeing right now when people are applying for their mortgages? Are there certain, arms or conventional loans? What are they typically trending towards? And what do you see as maybe some options people don't know about?
Right. So that's a great question. So what I'm seeing now is for a very long time, people were doing two things. They were using adjustable rate mortgages, and they were also buying down interest rates with points. Okay. So for the last couple of years, the yield curve was very flat. So there was not a huge discrepancy between an adjustable rate mortgage rate and a 30-year fixed mortgage rate. So the conversation was very limited on adjustable rates, right? The same thing with points, because rates were so low, people were not inclined to pay a fee to buy down their interest rate.
Right.
Now, with this huge increase in rates, now we're starting to see a trend where people are saying to themselves, okay, there could be 0.5% or maybe even more of a difference between a 30-year fix and an adjustable rate. And when we say adjustable rate, we're talking about a rate that could be fixed for 5 years, 7 years, and 10 years, right? And a lot can happen between 5, 7, and 10 years. For example, we may go through another cycle with rates start to come back down again. And if somebody enters into an adjustable rate, let's say a 7-year adjustable rate where the rate is fixed for 7 years, and 2 years from now, rates come back down, they can refinance into a lower rate if they need to. So we're starting to see a lot of that. And then the points. So what is a point? A point is 1% of your loan. And essentially what you're doing is you're giving up a fee of 1% to buy down your interest rate. And that's usually anywhere between 1/4 to 3/8 of a percentage point.
Okay.
And it's a useful tool to hedge against a rising rate environment. A lot of my clients will say, well, what can I do to lower my rate? I have the best credit score. I have a great down payment. What are some other options that I can do to lower my rate? And then those are the two conversations we'll have. We'll say, you could take an adjustable rate, or you can utilize your fee to buy down your interest rate. The only issue with the latter choice of buying down your interest rate with a point is that if rates do come down within a few years, there is a break-even point, meaning when you pay a certain amount to lower your rate, let's say that savings equates to $100 a month, you need to make sure that you're in that mortgage for at least a period of time where you've made up the fee that you've paid to lower that mortgage.
That makes
So
sense.
if rates come down in 2 years and you have to refinance and you paid that point, you're going to lose that money, right? So those are the conversations that we would try to have to figure out, what people feel most comfortable with.
Oh gosh, there's so much to know. I have a question. So many of our buyers are millennials, and for them, they've never seen a rate higher than 5%. They even think 5 is high. And for those of us who've seen different cycles, we've seen 12% for people with good credit. So to help them understand, how high can rates actually go, or might they actually go in the next year?
Right. That's a great question. I think there's going to be a cap. There's going to be a ceiling on where rates could effectively go because of home affordability, right? There is something called wage inflation that, again, the Fed is very much looking into and paying attention to. So we need to make sure that the rate of wages, increase in wages, is meeting the cost of owning a home, right? The cost of housing. But that also goes hand in hand with renting too, because the alternative to owning a home is renting a home. And those two things are becoming extremely expensive.
Yeah.
So I wouldn't be able to put a number on where rates could go because a lot of factors could play into that. For example, inflation could start to come down and we may not see, rates hit 6 or 7%, right? Or we may see that if inflation is still a problem, the Fed has come out and said, we will continue to increase the Fed fund rate until inflation comes down to a certain number, whatever their target is. So it's hard for me to put a number on it. If I was to say, based on home affordability, based on the rate of wage inflation, I couldn't see rates increasing more than 6%, right? For a 30-year fixed. But that's just kind of a personal opinion. I think when I have this conversation with a lot of clients and a lot of people are saying, well, I don't know if this is the right time because rates have increased so much. It costs me so much money to buy the home. And I always say, okay, I always tell them that over the years, rates have been 10, 11, 12%, right? So we got to put that in perspective. Granted, homes were a lot cheaper then too, right? Yeah. But also salaries were a lot cheaper then. People are making more money now. So it all kind of falls into, it's all kind of balances itself out. But I simply put, what does it cost to rent a home as an alternative? Because in my opinion, renting a home means it's 100% interest rate, meaning you own nothing.
Absolutely.
Right? You're just paying this rent. And at the end of the day, you have no ownership, no appreciation, no wealth growth that comes from that. So you have to measure the alternative. And at the same time, if we believe that, I just had a video earlier today that said that the new home sales came out for May and it was 696,000 homes, new home built. To put that in perspective, we're still 3 or 4 million homes short of meeting current population demands.
Yeah.
Okay. That's not to say where the population will grow, 3 or 4 years from now. We're just looking at population demand today, right?
Right now.
So my point in saying this is that home prices, maybe in the next couple of years, they may settle down, but over the next 4, 5, 6, 7, 8 years, they're going to continue to increase, right? So I don't think I don't think the decision should be rate motivated. I think the decision should be, where do I think prices of homes will go, right? And what is the alternative? Where do I think how much do I think my rent will increase by?
Right.
And it will increase, that's for sure. Yeah. Is there anything, Greg, that you want us to know that we haven't asked you?
Oh, this is something interesting. I was actually going to have a discussion about this because a lot of people were talking about, I want to give you the statistics because I was looking at this. So a lot of people asked me about 2008, the financial crisis, right? And, how is this different than, let's say, for example, we're in a housing bubble, which I don't believe we are, but let's just say we are. How is it any different than the 2008 housing bubble? And I came across these 3 things that I thought were really interesting because I actually worked during that time in 2008. So I experienced, that financial crisis. And at the time, one thing I know for sure is that underwriting standards are very much different than they were back then, right? And what they said is that on average, since 2008, the average consumer, the home buyer, has a credit score that is 52 points higher than it was in 2008.
Oh, nice.
So that's really interesting to know. They also said that today's homeowners have excellent equity. In 2002, they've hit a record high of $11 trillion in home equity.
Wow.
So that's another reason, meaning people are not upside down on their homes. That makes a significant difference whether people are forced to sell or not, right?
Right.
And then mortgage delinquencies are at a record low with just under 3% of homes being past due.
Yeah.
That's
So
great.
I think these are 3 fundamental differences between then and now. And the fourth is the rate of population growth is a lot higher than it was back then. Meaning there's a stronger demand for housing than there was in 2008.
Yep.
Right. Very good points. All of them that people don't typically talk about when they ask, when they ask us, when they ask you about 2008, what's the difference?
Yeah.
Yeah.
This was great. Greg, thank you so much. This was great. We are going to be sharing this with all of our clients, our friends on social media. And I think what I'll say is if they have more questions for you, questions that we won't be taking on, we'll include your contact info and they can reach out to you directly.
Absolutely. I really appreciate it. Everyone enjoyed the beginning of the summer, and I look forward to seeing you guys again.
All right. Thanks, Greg.
Thanks, Greg.
Bye-bye.
Take care. Bye-bye.